Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today, as we begin to wrap up the year, we return to the crude markets. What has been going on in the latter half of 2025, and what is the outlook for 2026? How do prices reflect the current supply and demand story as well as geopolitical risk? And what are the key tension points as we head into 2026, and how might the markets break? And what has all this meant for traders this year, and what might it mean next? Our guest is Homayoun Falakshahi. He leads Crude Analytics at Kpler, the data and analytics firm for the commodity markets. As always, you can really support the show by leaving us a positive review on the platform you're listening on. And as always, I hope you enjoy the episode. Homayoun, welcome to the show.
Hi, Paul. Thanks very much for having me. It's a pleasure.
So we've got a somewhat of a tough task, if you'd like, certainly when you get into the details of catching up on where the oil markets, crude in particular, have been this second half of 2025, and then what we might expect, what are the key elements to look out for in 2026. So let's start with 2025, and I guess you're sat around a dinner party for Christmas and so forth. I guess I'd try and sum it up something like it's sort of an oversupply narrative fighting against a political risk narrative, if you'd like. Can you is that a fair assessment, and can you dig into where we've been in 2025?
Yeah, I think you've nailed it, Paul. It's really you look at the fundamentals, and a lot of what's happening seem and actually is quite bearish for prices, as you said. Huge oversupply globally. And it's something that really kind of got accentuated in the second half of 2025 with, OPEC Plus bringing all these barrels. And, they accelerated those hikes in the summer, but also non-OPEC Plus production really boosting as well. You had kind of a convergence of a lot of these projects starting at the same time, or at least hitting their production capacity at the same time, so towards the summer. And so that meant second half 2025, a lot more supply in the market. And at the same time, you have prices have been on a declining trend really over the past few months, actually, really since the kind of risk premium that we saw during the Iran-Israel war. But since then, it's been on a slow declining trend, but we haven't seen prices really crash despite, again, that oversupply. And I think one of the main reasons why it's what you outlined, and it's the higher geopolitical risks that are to be factored into prices, and a lot of uncertainties when it comes to what's going to happen around Russia, Ukraine, around Venezuela, maybe also around other places such as Iran, Israel. Also, I think the conflict is kind of just frozen. I don't think it's dead. So I think a lot of these reasons have prevented prices from crashing. But on top of this, of course, you have other things like sanctions on Russia, and also the Chinese stockpiling strategy obviously also supported prices.
Let's unpack sort of some of the more interesting pockets of that story, and I want to go back to sort of that supply picture. And in aggregate, is this just a normal commodity cycle playing out? 2018, 2019, people saw that actually, there wasn't enough investment going into hydrocarbons. That came through till sort of, the sort of energy shocks of 2022. And this is some of that paying off, or is there something else going on? And I know that's probably a different story for OPEC Plus versus non-OPEC, but can you just help us understand, is this investment paying off, or is this something else going on?
I think you're right. I mean, a lot of that was actually expectable and was to be expected because apart from the US, which you can highlight as a place which the shale play reacts much differently to prices, and so we're much more short term factors play a larger role in US supply. But apart from the US, you look at the other main countries, and if we focus on non-OPEC plus countries, these are projects that have been sanctioned a few years ago, and so a lot of that was to be expected. I would say that the big difference here is that you have a lot of supply that again has come at the same time. You look at some of these main places out of OPEC plus where supply has increased massively this year. So I'm really talking about the Atlantic Basin countries, the likes of Brazil, Norway, Canada, Guyana, and even Argentina. And yeah, you've had a lot of new supply just hitting reaching production at the same time, which is a bit odd. Was to be expected, but I think that due to the fact that we've had some project delays and so on, that also has pushed. And also on the other side, some projects reached production earlier. Like for example, the one Guyana FPSO in on the Yellowtail field in Guyana, reached production 2-3 months in advance. So yeah, a lot of that production hit the market at the same time. Was to be expected, and that's also, I think, why we haven't seen such a huge reaction from the market, despite the fact that that means there's a lot of oversupply. But as you say, I think these are typical cycles in the industry, and it means that I think if we look forward to 2026, but especially beyond 2026, it also means that we're probably going to have potentially more supply problems because we haven't invested enough in the past 2 years. These are projects that were sanctioned more than 3 years ago.
Mm. This is that sort of $500-600 billion gap that the IEA signaled, and many people think is a lot more, right? We've kind of got through this period, but actually, if demand doesn't tail off, well, even if demand continues as expected, there's that big investment gap. And if demand doesn't fall as expected, and maybe then it's a different story. Let's maybe we sort of talk about that a little bit later. But so you've had, and as you say, this is kind of in some ways very much an Atlantic story, a Central and South America story, with Guyana and Suriname and these huge finds, and Brazil coming online and Argentina and stuff, but predicted, and so the market was factoring that in. If I remember back to this time last year, we were having conversations with a few of your colleagues in other firms talking about this sort of what OPEC might do, and this potential that OPEC might just tank the market like it did a decade ago, and to sort of for various reasons. Can you just tell us what has OPEC actually done in 2025? Has that surprised people? Have they sort of threaded a middle course? What have they done?
Yeah, I think it's a very good point because indeed, as that increase in non-OPEC plus was expected, the key there was really OPEC plus's action. What was OPEC plus going to do? And I have to say, yeah, they took most of the market by surprise. I have to admit, including ourselves. I remember at the beginning of the year, simply because of the oversupply that we saw coming already without those OPEC plus barrels, incremental barrels, we were betting on the fact that they would have to delay their production increases. But yeah, they took the market by surprise, and I think it's a significant shift, quite a big strategic shift. Obviously, not just I think there's things behind the scene as well. It's not just pure oil market dynamics at play. I think it's also down to geopolitics and other factors that may have played a role. But if we focus on the oil market side of things, I think it's a huge strategical shift, because they were saying their strategy actually become a lose-lose strategy. Not only they were withholding production, not reducing production over the past 2-3 years, so between 2020, end of 2022 and 2024. And at the same time, you had prices, on a steady decline over the past 2 years. So it's not like, they reduced production, but at least their revenues kept steady because prices would increase. They may have actually allowed for prices to drop at a slower pace than what they would have, but it was becoming a losing strategy on both sides. And so I think the fact that they actually went ahead and took a huge took on a huge shift in their strategy is quite meaningful. And I think forward looking, it's something that we believe will continue, and we think they will reap the rewards probably be after 2026, because 2026 looks still quite oversupplied. But after 2026, it looks like at least we do believe that prices could be reversing the trend towards the upside. And so it's more the long-term play that they've been playing here.
So they kind of win back market share. They potentially delay other projects, push out competitors, non-OPEC competitors. And then in 2027, when that kind of supply gap comes through, that lack of investment comes through, they're in a great spot then. It's kind of the big picture strategy, right?
Exactly. I mean, you look at, OPEC plus production versus non-OPEC plus. OPEC plus production dropped by 860,000 barrels per day in 2023. It dropped by 1.3 million barrels per day in 2024. Meanwhile, you had non-OPEC plus output that jumped by at the same time. So when OPEC plus was dropping by 860, non-OPEC plus production was increasing by 1.6 million barrels per day. And then when OPEC plus dropped by 1.3 in 2024, non-OPEC plus increased by 725 KBD. And even this year, despite the fact that they've changed their strategy, we still see non-OPEC plus stronger than OPEC plus increase. So OPEC plus, we believe, has increased on a year-on-year basis by 700, when non-OPEC plus increased by 1.4 million barrels per day. So yeah, I think this really indicates the market share that they were really losing, and I think it's even more telling when you look at the exports from these countries. It's really telling. Unfortunately, I cannot show you that graph here, but I remember that I created one where you easily see that those exports from OPEC plus dropping the past 2 years continuously, or at least on a quarterly basis, when non-OPEC plus increased. So, and I think you look at what happened this year. It is already starting to pay off, in the sense that you look at the past 2 quarters, Q3 and Q4, where we are currently in Q4, we are seeing exports from OPEC plus overtaking exports from non-OPEC plus. Well, non-OPEC plus exports are still growing, but at least the pace of growth from OPEC plus is stronger. And the difference, we're talking of about 500 KBD higher in terms of OPEC plus exports growth on a year-on-year basis in Q3 and Q4 versus non-OPEC plus. So it is already starting to pay off. I think this is probably the first point, key point of the strategy. And if I were to describe their strategy and decision making, at least on a pure oil market focus, I would say the first one is market share, and the second one probably is managing that spare capacity. Because if you remember, over the past 2 years, in 2023, 2024, sometimes we had some shocks which triggered a short spike in prices, but then usually prices, after a few hours sometimes, or sometimes a few days,
I mean, short shocks like bombing Iran,
that's one of them, of course.
Within 12 hours.
Absolutely.
Yeah.
And I think one of the reasons why every time you had prices coming back very fast, cooling down, was because the market was aware that the level of spare capacity within OPEC plus was still very, very high. And at the beginning of this year, we had assumed, our estimate was that OPEC plus spare capacity was at 6.5 million barrels per day, which is roughly around 6% of global demand, and much higher than historical levels of, usually that spare capacity globally is more around 3%, and most of that in Saudi Arabia. So I think the key goal for them is to bring that level back to closer to historical levels of 3 million barrels per day, so that when there's a market event that should trigger a spike, then the bulls would would not shy away and would be much more comfortable holding on to their positions.
The energy and resources sector is experiencing unprecedented change. To help navigate this change and capture its opportunities, HC Group launched Enco Insights, a global advisory network dedicated to the sector, providing senior advisors and subject matter experts to investment and infrastructure funds, law firms, and corporates. Enco Insights leverages HC Group's 20 years of connections in energy and commodities to give clients the expertise they need when the stakes are high and insight matters. Learn more at encoinsights.com.
Yeah, Is there in some ways we're in danger of thinking of a world that hasn't experienced inflation, or at least I am, right? So I think of $60 oil and I think, that's not too bad. But ChatGPT tells me that if you do inflation adjusted for the price versus a decade ago, it's basically the same, right? So today's price, inflation adjusted, is compared to 2015 is $43, which is basically where we were in 2015. So are we actually in an oil market at the moment where it is completely reflecting that oversupply? Prices are unbelievably low, and if they were, and probably, are in some ways at that kind of base level that we hit a decade ago in the nadir of the commodity cycle. Is that a truer picture than thinking crude prices are okay and that reflects political risk? Is it actually they're at rock bottom? It's just that we've had 40% inflation since 2015.
I think for sure, that's absolutely true, and it's actually something that if you look at the OPEC Plus press release and what they say, that they focus on, they highlight the fact that if you compare all the commodities, in the past 10 or 15 years, oil has been extremely stable in terms of prices, despite the sort of crisis that we saw and the increases that we had in 2022. And I think, but the fact is the main divergence here between oil and other commodities is obviously if you look at demand, even though demand is there's still demand growth, right, globally, and we expect that to continue for until at least early into the next decade. But that demand growth is obviously really, really weakening, and we are seeing that shift take place, especially in places like China, where demand is already kind of plateauing, partly because of the growth in the EV fleet that we see in the country. And I think that's one of the key differences between oil and other commodities. You look at most of the other commodities, thinking gold, silver, copper, aluminium, and so on. We're potentially we could be at the beginning of a new super cycle for some of these commodities, and it doesn't look like it's the case for oil because of oversupply, but I think more fundamentally because demand for oil is already nearing its peak, and unfortunately for bulls, there's not much that really can be done. So I think there is going to be this. Is still going to see cycles in the oil space. But I think it's hard to foresee prices, really strongly going on the ups towards the upside, even in the event of political shocks, and that's because again the pace of demand growth is just not there.
But what does that mean for OPEC Plus's strategy for 2017 and beyond when they see this sort of lack of investment coming through? That are we just simply saying that the price of oil is still, bounded by this fundamental lack of demand? Even if there are going to be price spikes, they're just not going to be as high as we've seen historically.
I think so, and I think there is that realization already within OPEC Plus, and especially for the leader of the group, Saudi Arabia. There's the realization that, especially in the short term, right, it's hard to see very high prices. Now, because of the lack of investment in the past 2 years, later in the decade, after 2026 and 2027, prices we do believe that should be a bit higher than where they are now, but not massively higher. Probably we could head closer to an average on the year, around $80-90 per barrel Brent. I would say, which again would be much more comfortable, right, compared to where we are now.
And inflation adjusted is somewhere like that 60 that we've kind of got in our heads right now as not being too bad, right? Yeah.
Yeah, absolutely. Indeed.
Yeah, I just find it sort of fascinating that actually we sort of, I've been salving myself with this idea that it's at 60, but really it's at my historical 40. Okay, so let's and we're going to come on to what this has meant for traders, and sort of a sneak peek is obviously it was a bit of a rough start of the year, but a slightly better second half when kind of all of the rule by tweet got replaced by some more normality in terms of supply and demand and fundamentals and a bit more directional. But we can argue that. But let's talk about that demand piece. And again, thinking about this time last year, we'd had that sort of first slew of data out from China that was like, this actually looks like they've sort of hit the peak oil demand. There's been a tipping point in EVs. Has that narrative been strengthened in China, and actually where we have seen demand, it's been for their strategic reserve? What's going on there?
Yeah, that's a good point, Paul. I think look at Chinese demand. It is plateauing because of a huge massive fleet of EVs, and they're probably starting to. I mean, it's a trend that I would say probably is going to accelerate, and as most of the EV makers in China are actually looking more at going overseas as well, as expanding overseas now that the domestic market is starting to get that saturated. So you look at demand growth in China, it's still there, but and it's still actually one of the biggest, the largest growth markets, for oil, for core products, for example. We're talking of about 350,000 barrels per day growth next year. So yeah, it's not much when you compare it to total Chinese demand. It's like a jump of about 2%, but it's still much more than what you can find elsewhere. In Europe, for example, it's stagnating. In the US, it's only growing by like half of those volumes in China. But I think you look beyond the core products, actually what is going to be overtaking core products in the next 2-3 years, we do believe is going to be the case, is the increase in demand for LPG and ethane. And that's due to a lot of new PDH plants being constructed and implemented and launched in China. So that actually is going to have also another impact. By the way, it's more a detail of the oil market, but it's going to have an impact on the crude quality pricing and differentials because the plants over there are going to be looking more for the lighter, sweeter type of barrels that they can process at those type of new demand centers. And I think you're right. This year the Chinese stockpiling story has been a massive one, and it's probably one of the main reasons why prices haven't dropped much in the second half. And you look at between March and right now in December, China has absorbed about 90% of the oversupply that we had globally. So that's really a key, I would say, factor and reason to continue watching over the next few months to try and assess if the market is going to break, if something has to give, is it prices, or is it not going to be the case simply because China continues to massively buy. And I think if you look at their storage capacity, which they are strongly expanding, everything seems to suggest that it could continue next year, and it is actually we do believe going to continue, and we do think that this year they built their inventories by more than 100 million barrels. Next year, we could have at least as much as a build, if not more, because of even higher capacity. Now, there's a few reasons, why they could be doing this. Maybe linked to the geopolitical situations. Maybe they are expecting something around Russia, around Venezuela, around Iran. Who knows? But also maybe they are preparing for something else. There's some rumors in the market as well.
It's pretty terrifying, right? And we actually did an episode in the summer on wheat markets. We called it War and Wheat. Talking about actually when you went back, you could see Germany start to stockpile core commodities prior to launching both invasions in both world wars. So I mean, it's not sort of particularly heartening to hear that. Where does this rise in oil on the water come in? Can you tell us what that is and what that potentially means as well? Because that seems to be the story of right now.
Yeah, I think it's really partly the result of that oversupply that we've started to see kicking in, especially in the summer. So I would say that it's again mainly the result of that, but not only. There's a lot of I would say short-term, medium-term reasons as well, other drivers that have explained that. So just to give you some perspective, we've seen oil and water volumes jump by about 200 million barrels, even a bit more, since September. And to put that into perspective, that's about 20% increase. So it's quite massive because the pace of the increase and the length of it is just comparable with a crisis that we had like COVID 5 years ago. So very significant, and at the same time, you could think that oversupply it is going to impact the market structure. If there's that much oversupply, we should have seen market structure head into contango, for example, and it's not the case. I mean, of course, the backwardation isn't that steep right now on the key benchmarks in the oil market, but it has weakened quite a lot, but it's still in backwardation. So I think to us, it indicates that, yes, there is an oversupply in the short term, but a lot of that is also linked to other factors such as, and what the main one we think being that there is kind of a divergence between where refining capacity right now is and where the supply increments are coming from. And that's because if you look at this year in 2025, you had, if I'm not mistaken, about 600 kbd of capacity closures, and that's mainly in the west of Suez. In Europe has closed 2-3 refineries. Likewise, in the US, you've had, for example, in October, no later than October, you had the closure of the Los Angeles refinery. Earlier in the year, you had the closure of the Houston refinery, and so that means that demand for actual crude has come down because of those closures. And on the other hand, the new capacity is more in the East, in Asia, in the Middle East. And so that means that also, the crude has to be on water for a longer period, because it is originating now incrementally from the west of Suez, and the demand is actually mainly located further away, such as in Asia. So that's part of it.
So travel days have gone up, basically, is part of it.
Yeah, absolutely.
I guess the question is, so there's all these sort of the redirecting of flows and these and so forth. Is there anything a part of this story that all the traders are loading up on VLCCs or sort of parked somewhere quietly, waiting for a big oil for contango markets? I mean, is that any of that story?
We're not seeing that. We're not seeing that because if we have done quite an extensive study looking at this topic, and one of the metrics that, for example, we were looking was the pace of the pace of moving for these ships, like for example, have we seen slow steaming? Have we seen some tankers move, let's say 2-3 knots slower than usual? And it's not the case, actually. So I don't think that's one of the reasons. I mean, also another reason behind this increase is the sanctioned barrels, and the fact that you've had those sanctions on Rosneft Lukoil recently, increasing sanctions on Iran. And at the same time in China, and at the end of the year, most of the private refiners have reached the maximum for the quota. And it's true that the new quotas have been released just about last week, I think, 2 weeks ago, late November. But it also has reduced the willingness from some of these refiners in China, for example, to import in the short term, very short term. So there's some of those factors which are more short term driven, like the Chinese quota constraints. Some you could say more medium term driven, like the sanctions on Iran, on Russia. I'm saying medium term because who knows, maybe you can have an agreement tomorrow on Russia, Ukraine, and some of these sanctions get lifted. I think that's part of that. The open arbitrage is also part of that, meaning that the barrels from Brazil, US are still cheaper than barrels from the Middle East into Asia. And actually, if we look at the destination of this crude, most of that incremental build is going to Asia. I think out of that 200 million barrels, we're talking about 150 million barrels, which is going to Asia, and most of the remaining is still unknown because for us it takes sometimes a few days or weeks to exactly estimate where the destination of these cargoes is. And I think lastly on this point, which is again quite interesting because it points to why markets haven't really crashed despite this huge build on the water, which in the end is going to mean a build on land as well, right? Because these barrels at the end of the day are going to hit onshore and are going to, in the first place, being stored in onshore tanks. And it's the fact that if you look at the product side of the story, the products on water have actually been decreasing over the same period. So since September, we had 20% or roughly 200 million barrels increase in crude on water, but we had a 50 million barrels drop in products on water. So that's roughly about a 10% decrease in products on water. And again, I think it really points to that dichotomy or that divergence between where new refining capacity is, and the fact that new refineries are also kind of slow in terms of ramping up their operations, such as, for example, Dangote in Nigeria having had a lot of issues, and the fact that products market are quite tight. Stronger margins mean that this really is an indication of a looser crude market, but a tight product market. That means that the prices are still holding up quite well despite the huge build.
Yeah, which brings me nicely to, I guess, one final comment talking about 25, and we can crack our crystal balls out and have a look at 26. But the narrative from trading performance in 2025 has essentially been one of very tough, for the most part, in general, for crude trading desks, better performances from the products desks. I know, obviously, you're in the business of supplying data to these guys, but do you have any? Because where do you think that's coming? Do you agree with that narrative as a synopsis, and where do you think that's coming from?
I mean, I think, first of all, I agree. You look at where margins are right now, refining margins, where cracks are, a lot of volatility. You look at how crude prices have been behaving for most of the year, and that includes the market structure. It's been a lot more boring, I would say. Not so much volatility, or at least you had some volatility, but in a much narrower range. So I'm not surprised to hear that the traders have been doing a lot better, I would say, on the products side of the market. And I think where this is coming, it's mainly so. There's two main reasons, I think. The first one is, again, the decisions that we're taking before 2025, so the closure of some setups in the Atlantic Basin, namely in the US and in Europe, and new refineries coming up, being a bit slow to ramp up, the likes of Dangote in Nigeria, the likes of Dos Bocas in Mexico, or other setups in Eastern Asia. And the second point, and the most important one, is I think the big flip in the US positioning on the Russia-Ukraine war, which allowed Ukraine to really ramp up its attacks and drone operations against Russian infrastructure. Because I think most of those, that spike, that increase that we have seen in the products market, or at least that volatility, is really due to the fact that we're seeing a lot less Russian products hit the market. Russian crude exports are still very high. They're actually at almost an all-time high as I speak, despite the sanctions on Rosneft and Lukoil. But exports of Russian diesel, especially, have almost halved, since spring this year, and that has really allowed for a huge reshuffling of the products market, with countries like Brazil, for example, becoming short in diesel, and so turning up to new markets for the diesel supply, and that means that generally speaking, stronger margins have really allowed for a much stronger products market, and that also supported crude markets, because otherwise I think that we probably would have seen oil prices drop a lot more than what's been the case so far.
Hello, I'm David Hunt, founder and managing director at Hyperion Search. Founded over a decade ago, Hyperion Search has helped organizations from major utilities to startups recruit their leadership teams and key individual contributors to accelerate both their growth and the energy transition. Our three main verticals are renewable power, energy storage, and e-mobility. The energy transition and the talent that delivers it has been our passion since day one. To find out more, visit hyperionsearch.com or listen to my Leaders in Cleantech podcast, available on all platforms.
I guess the segue there really is Russia, Ukraine, and then we also need to throw Venezuela into that mix. And, the US being the source of geopolitical volatility at the moment, ultimately, both in policy towards, to both those countries. Where do we, at the moment, let's start with Russia, Ukraine. What's the general expectation out there, do you think, from the market on that conflict and how it plays through into crude markets?
You know what? I think what's interesting here is that for crude markets, it's not going to have much impact, even if you have a deal tomorrow and even, let's say, a ceasefire, and let's be ambitious, total peace signed between Russia and Ukraine. If you look at the crude side of the equation, it hasn't really been impacted by the war. I mean, of course, you have had sanctions which decreased indirectly the price of Russian crude for the buyers. Russian crude still much cheaper than the competition, but I think it's really hard to see the likes of the European Union countries go back into buying Russian crude. I mean, it could happen, right? I'm not a geopolitical analyst, but still hard to, being based in Paris, living in close to the center of Europe, I would say that I would be very surprised if this.
It seems, I mean, the sort of, schizophrenic almost in terms of kind of, on the one hand, we sort of see various attempts at rapprochement. We've seen Putin actually leave Russia, obviously, to come to United States soil. At the same time, you're seeing the US government be, in many ways, tougher when it comes to energy policy than the Biden administration, right? We've just gone through the sanctioning of Lukoil. That puts, I think, was it 3 refineries in jeopardy around the world. That's going to add to that disparity between crude and products if something doesn't happen. And then the cascading events at Gunvor, this is me saying it, not you. I mean, if anything, if you kind of just look at actions rather than words, we could expect further, as tightening. And actually, we're talking early December. Last week, you had a tanker hit on the water in the Black Sea, right? I mean, it would seem that those attacks on Russian infrastructure will continue, that actually you might have a tightening of sanctions, or in the very least, companies far less willing to move Russian barrels if the US government really starts to get aggressive around even financing some of these trading houses and so on. I mean, it seems quite a perilous picture out there. It doesn't seem like things are normalizing anytime soon with regards to energy markets.
Yeah, I think we're really within a new order that started, in 2022, but that's not going to change. I mean, even if there is a ceasefire, and most probably in one day you will have some sort of a peace or the conflict becoming a bit more frozen. But I think the new order where we are in, which really has Russia a lot closer to the kind of emerging powers, or I'm thinking about India, Turkey, but obviously also closer to China. I think this is going to stay, and I think it will take years for example, the EU to go back into considering buying Russian crude again, or Russian, or increasing their imports of Russian LNG or natural gas. And so I think that the new order where we are in, every player in the world is trying to get the most out of it. And so whether that's Russia, obviously the key point here is to keep the exports elevated at the maximum and try to sell at the highest price possible. Now that's not really possible anymore because of the sanctions. I think if you look at it from the U.S. lens and the Trump administration, they're really trying to solve that issue, or at least to have a sort of victory, so that Donald Trump can call himself another time a peacemaker. And they know that one of the key tools that they have is sanctions. But the sanctions that they have been implementing on Rosneft Lukoil, they are not crazy either, right? Like they haven't implemented, for example, secondary sanctions on Russia. Because once you do implement secondary sanctions, then for sure you have India, for example, totally stopping imports of Russian crude. But for example, the sanctions on Rosneft Lukoil have not prevented India from importing Russian crude, even though that has decreased in the short term.
Although there have been threats, right? I mean, again, it's sort of
yeah. There have been threats. Yeah, absolutely.
It's hard to fathom. But I guess there's a sort of that's a live topic and well covered. I guess the bit that's sort of the wild card for me and a bit less understood is obviously what's Venezuela, right? And if I can frame it up, we're sort of in this bizarre situation where sort of a pretty significant battle fleet is surrounding Venezuela. At the same time, you've got Chevron with license to produce from Venezuela. You have this added complication that all of the US refineries demand heavy crudes, which doesn't suit what we've been producing in shale. That's why we continue to import Canadian crudes from elsewhere. Obviously we weren't on this little podcast figure out what's going to happen there. But in terms of scenarios, how big do you think, does the world think that crude is part of Venezuela obviously is a very big part of the story is the crude story here. If there is a conflict of varying shapes, what happens to the market at the moment in terms of if those Venezuelan crudes stop flowing? Are they already at a low ebb? Can you help unpack that for me?
Yeah, I think the impact is very limited. And again, to me it seems that historically for one of the most important energy policies for the US president is to keep gasoline prices low, to keep gas prices low domestically, right, for the US consumer. And that's also a boon normally for the US economy. And I think there is the realization within the White House that if you go ahead with, let's say, the most extreme scenario, which would involve a war between the US and Venezuela, I think you still wouldn't have a huge reaction in the oil market. And that's simply because you look at Venezuelan production and exports, and it's really, really limited. Like the country has lost about 70% of its production capacity in the past 7-8 years. And so the average exports so far this year is roughly around, if I'm not mistaken, around 850,000 barrels per day. And even if there's a war, no one really could be able to predict what's going to happen to the exports. Maybe you would have those flows continuing, just like you had the flows continuing, between Iran and Israel. So I think there is the realization that even if in the worst extreme scenario, the oil market is going to react, of course, but you're not going to have the reaction that we had back in 2022, at the beginning of the Russia-Ukraine war, when Brent jumped to as much as close to $140 per barrel. And I think the fact that the White House knows this, they know that they have relatively the upper hand here with Venezuela, and so it allows them to, becoming quite much more demanding, I would say. And same with Russia. Again, the sanctions are not going to be having too much of an impact on prices. Whenever you have that headline on if there's going to be a ceasefire or not, you lose or you gain about $2 per barrel, which is about, let's say, 3% of an impact. But the oversupply is such, I would say, in the market that even if you lose Venezuela, even if you lose a bit of Russian crude, even I would say if you lose some barrels from Iran, yes, the trend could be reversed. We could have higher prices, but it's not going to be the reaction that we used to see a few years ago. Now that said, the reaction, the oil market structure is going to be changing, and especially the differentials for those heavy crudes, as you mentioned, Canadian, for example, is going probably to gain a lot more. The other crudes from the heavy sours from Latin America, or other places in Latin America, are going to gain, because if you lose Venezuelan crude, then yes, the heavy crude market is going to get a lot tighter, and especially in the U.S. Gulf Coast and maybe in China. But the actual crude, let's say, front month prices is not going to be reacting too massively. And that's, I think, something that the White House knows, and they are playing it at their advantage.
Yeah. So we've covered, obviously, probably status quo with Russia, Ukraine, just continuing worsening for everyone involved there. Venezuela, goodness knows, but the short-term impact on oil markets probably is somewhat limited, just given where the status where they're at. Where else, when you look at 2026, we've kind of painted this picture of continuing oversupply into the latter part of this decade, when the bet is, and it's certainly a bet, that this lack of current investment going on will start to pay off for OPEC and non-OPEC countries alike, where significant money, talked about Guyana and so on, has been going in. What else? I guess in 2026, is there anything else that is on that could fit into that surprise category, if you'd like? And I know that's the one of the hardest questions. But is there anything out there that people should just have their eyes on, that might have an outsized impact on crude markets?
I think beyond the general geopolitical surprise that you could see, so whatever happens with Venezuela, whatever happens with Russia, Ukraine, and maybe with Iran, beyond that, I think one of the key topics is going to be the crude quality imbalances that we are going to have, because most of the new barrels coming from the Atlantic Basin are light sweet or medium sweet type of crude. And that's when the new demand, so the new capacity that's been installed mainly in the Middle East and in Asia, is actually more inclined to process medium sour or heavy sour type of barrels. So I think I would say it's hard to, obviously it's impossible to predict the biggest surprise of next year, but I think my expectation is we're still going to stay within a relatively boring market. Volatility, pretty much limited volatility when it comes to crude. However, within that crude market, if you look at the different grades, there's going to be a lot here to play around. Because, for instance, if we look at 2026 year-on-year supply, we have medium sour and heavy sour overtake by a lot more medium sweet and light sweet, and especially it's really medium sour versus light sweet. So, for example, we see 700 kbd next year of higher supply globally of medium sour, and that's mainly coming from OPEC Plus. It's mainly the baseline actually effect, because when I say 700 kbd and 1,000 barrels per day, I'm not even including the potential future hikes from OPEC Plus. Even if they don't hike anymore, on a yearly average, we should have 700 kbd more medium sour globally production. On the other side, light sweet, we should see a decrease of about 100 kbd globally. And that means that if you remember what we were talking about earlier, we were saying that most of the new demand next year is actually going to be the first year where LPG ethane demand growth is going to overtake that of core products. And that means that, at least in the short term, and in H1, we are going to have strong demand for those sweeter barrels, lighter barrels.
That's all China's huge amount of petrochemical industry that they've developed over the last couple of years, right?
Absolutely.
So that's good news for shale producers, presumably.
Yeah, that is, as long as they can sustain their production, indeed, it is.
And that sustaining it is the concern about those fields getting more rapidly depleted than thought.
Yeah, I mean, again, back to your surprise question, and it's been a surprise for, I would say, the past 10 years, maybe every year. It's really the behavior of U.S. shale This year for sure has been one of the biggest surprises, and I think, yeah, again, thinking this over again, next year, potentially that could once again become one of the biggest surprises. We do actually see U.S. shale production peaking right now. So on a yearly average, maybe it's going to remain stable, but on a December to December basis, we do think that U.S. output is going to decline by around 300 KBD.
It has continued to surprise to the upside, is the fair statement, right? Every year there's sort of this same prediction of its impending doom, and every year it continues to outperform. And so there's also the argument there's no reason it shouldn't do the same next year, right? It's certainly a live topic that we've discussed on this podcast as well, about sort of, where it actually is. But the story of this year is actually outperformance as opposed to that predicted decline.
Yeah, for sure. I mean, the efficiencies that we've seen, especially thanks to longer laterals, have been massive. Right now, total U.S. production around 13.8 million barrels per day at a record high. But I think we're starting to see the cracks, though. For example, I think the latest 2 readings from the EIA showed that production from Texas and New Mexico, if I'm not mistaken, have been on the decline. So I think we're starting to see the cracks, and that's why we believe that despite the fact that you've had a lot of efficiencies, at the end of the day, what really matters remains prices. And with the break-even of new wells in the shale sector, roughly around $60 per barrel, that's more or less where we are right now, right? So if you have a bit of a decrease, then the impact is going to be relatively big. I mean, again, we don't foresee that. We do think that prices will mainly remain range bound. Again, between 60 and 70, we actually do think that the trend will be reversed towards the upside, and that U.S. production is going to remain strong. But we still expect a peak in U.S. output, and that's because of lower upstream activity over the past few years, lower drilled but uncompleted wells, lower rig count, and so on and so on.
Yeah, and that sort of $60 break even, actually underneath that is a bell curve, and there are some barrels that are production that's break even at 30, right? And it's actually how that proportion lays over that 60 mark. So it's worth sort of doing the deep dive there as we've just discussed previously.
And the consolidation also plays into that. So you have
so exactly with these large the large producers owning it is a very different picture to how it looked 10 years ago.
Absolutely.
So I mean, fascinating. So there's hope and life there for the crude traders in this imbalance of grades. There's continues to be significant political risk out there, which many argue is underpriced, and the world is becoming ever more fragile as some of its structures for dealing with conflict and risk are being eroded. And I guess the look is towards 2017, and that plays into a conversation we've got coming up around actually are the super cycles or the commodity cycles shortening, in a more volatile world. But Homayoun, it's been absolutely fantastic to have you on. I've really enjoyed the discussion. There we were worried that we'd run out of things to say in 30 minutes, but we're approaching the hour, and I hope to have you back on this time next year, and we can see where we're at. And luckily, both of us have been quite wise and avoided any kind of predictions. So no one can prove us wrong.
Yeah, it was my pleasure, Paul. It's been a pleasure to be on the show, on the podcast. Thanks a lot.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.